Hey, welcome to the Retirement Answer Man Show. My name is Roger Whitney. I'm your host. This is the show dedicated to helping you not just survive retirement, but actually have the confidence to rock retirement, which might be, not having that confidence, I think, is one of the retirement crises that we struggle with, is having the confidence to really live the kind of life that you want after decades of working so hard. Andy Panko from Tenon Financial. And Andy, what's your website name, by the way, or address?
Tenon Financial, T as in Thomas, ENON financial.com.
I want to make sure we mention that because he is a practicing financial planner and a tax expert. I have come to anoint him. Andy, it's excited to have you here to continue this series on tax management in retirement.
I'm super happy to be here. And I'd be remiss if I did not say congratulations on, this is the 400th episode of the Retirement Answer Man podcast.
I hardly realize this. Look at now, if you're listening via the podcast, the Retirement Answer Man podcast, you cannot see Andy in his birthday hat. So we'll probably have it. We'll make this maybe the photo for the show. But thanks, Andy. Yeah, 400 episodes over 7.5 years.
Yeah, tremendous accomplishment for you. And just quick story, I first came across this podcast, I want to say 2015 or 16, searching for retirement planning knowledge, came across this and was just blown away at how good it was, how thorough it was, and how practical it is, and how it's not just facts and figures and numbers. Like what I really enjoyed, for example, you did a whole month-long thing about RVs. I was like, wow, this is absolutely brilliant. and here we are a handful of years later, and I'm super honored to have the opportunity to be part of this. So thank you. Congrats again for making it to 400. Here's to many hundreds more.
Amen. And thank you for being part of it. I think one thing, Andy, you and I have in common, other than dashing good looks and witty personality, is when it comes to financial planning and specifically retirement planning, we're about actually doing things, about how do you actually do this in not a simplified way, but not making it overly complicated.
Right.
And I think when we think about retirement planning, and maybe this is a legacy industry thing, because we used to wear French cuffs and work in mahogany-lined conference rooms, we tend to make it way overcomplicated and quote-unquote sophisticated when it doesn't really need to be. Mm-hmm. And that doesn't make it very approachable for, a normal person.
Right.
I guess it's sort of like how it used to be with doctors, right? It used to be the doctor was godlike and whatever they said you did and didn't question. Well, we know that's not true in the medical community now, but it's also not true in financial planning. It's a collaborative approach, and that requires someone like Andy or myself that actually work with clients to have a little bit more humility and think of it as, this sounds weird, think of it as equals collaborating to come up with great solutions rather than some expert that can never sound dumb.
I like that and agree with that. And I noticed that myself in the medical world. It seems like doctors used to say, here's what to do it. I don't know if it was a change in their mindset towards liability or this goal to be more collaborative, but it seems like they don't give such black and white diagnoses or recommendations anymore. Now it's kind of, here's your options, here's the pros and cons, you choose what to do. And I'm like, man, just tell me what to do. He's like, no, here's your options, you choose. For better or worse, that's how medicine has seemed to evolve. And I agree. I think finance planning, retirement planning, is along the same lines. And there is humility to it. We don't know all the answers. We cannot predict the future. Our job is to give guidance, advice, recommendations, point out the pros and cons, have a collaborative discussion with clients about, okay, if you do this, here's what may happen, here's what's good, here's what's bad, or if you do this, et cetera. That's how things should be. And now when the client completely has no idea or otherwise punts to us to make the decision, then sure, then maybe we assert a little more conviction in, going one way versus the other. But otherwise, it should be an open-ended collaborative thing.
There's a line there, and I don't know where it is, because I definitely get that. Well, I get to, what would you do? Yeah. Right? That's usually what someone will say to me. And that's essentially a good part of what you pay a planner for is, and there's a line between just telling people what to do, which, to be honest with you, is a lot easier. Mm-hmm. Right? There's a lot less, it's a lot easier for the client in a lot of ways, and it's easier for the advisor because there's not this ongoing discussion. There's a line between doing that and just simply laying out the options. Because, because I want to help, I want to always have an opinion. On the show, I always want to have an opinion. And with a client, I do. Because otherwise, if you're just laying out the wheres, now it's still all on the client, and it may have helped them navigate a little bit. I have and recently with a client, this is maybe 3-4 months ago, they had this large concentrated position in a number of equities. And they were transitioning toward retirement, and we needed to de-risk. We needed to get out of this accumulation growth mindset to at least something a little bit more balanced. So that was the issue. And I came up with my first proposal of, okay, this is how I think we can navigate this, being mindful of taxes. And so I email it to the client saying, this is what I would recommend based on our discussions and the facts. And then we had a follow-up meeting. I wonder if this ever happened to you. We had a follow-up meeting, and this person is pretty active, very, very intelligent. And he said essentially, yeah, this really makes sense. But, I was thinking about this the other day, and here's what I thought of. And then he showed me, which was accomplishing the same goal, but in a very different way. And I'm looking at it, and I'm looking at, the model that I put together, and I'm like, you know what? That's better. Let's do that one. Mm-hmm. That is what you would want, I would think.
Yeah, you don't need to be this godlike, I have all the answers. What I say is scripture mindset. And some folks do. Partly, I think it's an ego trip, or they need to feel validated that they're the smartest person in the room. But I think that's a dangerous approach to have.
Yeah, and even if you don't use a planner, I think that's something to watch out when you're putting your solutions together, because it's easy. I read a study, this is years ago now, that CIA did on their analysts, and I've mentioned this on the show probably hundreds of episodes ago, where they looked at how analysts would filter information, and what they found was the more intelligent you are, statistically, in their study anyway, the quicker you came to a decision, mm-hmm. and the more that you filtered any new information to fit what you've already decided. There was a correlation between intelligence and doing that, and that's something we all need to guard against, and especially you, Andy, because you're so smart.
Oh, stop.
And so good to have you. I think a good financial planner, or a good partner in anything, is a great decision-making partner. I think that's the phrase I like to use.
I like that.
Well, with that, let's be a decision-making partner, Andy, and talk about, last week we called it hidden tax bombs. We've already established why it's important. Let's open up the toolbox and talk about how we do this. What do we have to use to manage taxes in retirement?
Great. It should all start with some sort of broad understanding of your tax situation, both now and potentially in the future. Now, here's where things get difficult, because there's a lot of, as we mentioned in the previous show, a lot of educated guessing about the impact of these things. Like, you don't know with certainty what your income or taxes will be 5, 10, 20 years in the future. What tax legislation may do, what the financial markets may do. But nonetheless, you have to start somewhere. So, for example, if you have $3 million in tax-deferred accounts and you're 65, let's say, in 7 years, required minimum distributions are going to start. So you should try to put pen to paper and just get an estimate. What do you think RMDs may look like in the year 72? That would require a couple basic calculations. One is take the $3 million you have now and assume some amount of growth between now and when you're 72. Right? That's the tricky part. Will it stay flat? Will it go up 5%? Will it go down 5%? We don't know, but come up with something that feels dispensable to you. Then you can simply apply the Rmd factor, which is known. It is what it is, in the year 72, and that you can back into, okay, my anticipated IRA withdrawal when I'm 72 is going to be roughly X dollars. Then you can say, okay, what my tax rate is now. Maybe it'll be the same then, maybe it won't, but try to figure out how will that be taxed in 7 years. So that's the basic approach, and do that for your other sources of income and try to piece together what's my income now, what's my potential income in the future, how's it going to be taxed, in which moment in time is it more advantageous for me to pay more or less taxes? Is it now or is it possibly in the future? That's the basic framework for figuring out how and when to do the toolbox of opportunities we'll discuss today. And
I do that all the time on the RMDs, by the way. I think I use 5% as my default. And there's no science to that. So if you think of it, if you're hiking, it's very easy, especially with taxes, when you're hiking or walking in the forest where there are rocks and things, you want to have a safe path on your next step. Tax-wise, in the accumulation stage of life, you're typically looking at your feet. Right? You're looking at the next 2 or 3 steps. How do I save taxes today? How do I avoid this happening to me today, right?
Yep.
And what I hear you saying conceptually is in retirement, you really want to start looking a little farther out. You got to pay attention today, but what's coming up 3, 4, 5, 10 years is more significant or has more significance. Right, that might be a good way to say it.
Could be, and there is software to help do this. There's some really robust. There's some not very robust projection tools that planners and yourself, consumers alike, can use. But don't get too hung up in that. They're making assumptions and predictions about the future, and this is especially tough to say to mathematicians, engineers, scientists, technical-minded folk. They often can't accept that we're trying to solve the unsolvable. They want a finite answer on a report in front of them, and you just can't. When you're projecting out dozens of years of things that can change a lot, don't get too hung up in this. Again, have a starting point, some basic framework, but do not worry about trying to nail down a quantifiably precise answer because you simply can't.
And that's, I'll go back to our original discussion, that's the danger. Because someone will sell you will offer you a point of view that is finite, that says, yes, based on all these calculations, you should do this, and it's a drastic solution. There are plenty of people to offer those up to you because it's essentially feeding into that.
Yes.
The fallacy of precision. One of the best phrases, I forget where I heard it from. More accuracy does not equal more precision. The more accurate you are in your estimates of things isn't going to get you any closer to being precise in it actually being true. And that's a nuance that we don't appreciate as much. You look like you're thinking through that.
I'm trying to wrap my head around that. Accuracy. It's almost getting a little off track here, but I think it's Warren Buffett said something like, investing is simple but not easy, or vice versa. Like I had to really dwell on that for a while to make sense of what he was saying, but it seems like the same thing. Accuracy does not lead to better precision, or vice versa.
Right. I mean, I've had 20-minute debates with someone who's asking me, well, what about this number here, 10 years out in this column? What do we do about that number? And I'm like, I'm an agile retirement management practitioner. I'm not worried about that number near as much because that number is going to change a million times.
100%. It's tough to explain that to clients, especially the quantitatively minded. But that is the right, the best, the proper answer. So.
Yeah. But to your point, this foundation, you do want to map. It doesn't mean you don't map it out. It doesn't mean you don't map out, what my Social Security estimates are, what my RMD estimates are over 5, 10 years or your lifetime. You still do that because it will give you the framework to make decisions. You just don't look at it as gospel and something that's actually going to happen. But you still need that framework to look at and consider the tools that we're going to talk about.
Yep.
All right, so let's put our hand into the toolbox and pull out the first tool. Which one do you think of, Andy?
Filling up the tax brackets, the tax buckets. So, good example, you retire at 60, your wages stop, your income goes down, precipitously, quite likely. You did not yet start Social Security, maybe you have a pension, you are not yet starting, and you're not 72, so you don't have to worry about required minimum distributions yet. Starting that year, you have zero or close to it in income. Maybe you have some interest getting thrown off from your bank accounts, maybe you get a little bit of dividends coming in from your brokerage account, but your income is going to be tiny. Now, you may say, okay, this is awesome. I can get by with possibly having zero taxes for this year, so let me do that. Well, that may not be the best thing. If you have this big lurking, potentially multi-million-dollar balance of tax-deferred assets that's growing, you're going to have to pay tax on that at some point, specifically when you hit 72 and RMDs are starting. Then the income is thrust upon you, and you need to pay taxes on it. So to help trim that down, don't let your lower tax brackets go unused in these early years of retirement. Consciously fill them up, perhaps. Take out, depending whether you're single or married, it's like 60 or $100,000+ of IRA distributions will still only hit you to the top of the 12% tax bracket. Don't let that go unused. Fill that up now, as opposed to who knows what taxes will be in the future when income's forced upon you. Then you're at the mercy of tax legislation at the time. Now you have a little more control over realizing income, realizing the amount of tax you have to pay on it. Take advantage of it.
Yeah, and that's a sweet window, right? It could be, let's say you retire at age 60 and you have zero income, right? Like we were talking about. Well, if you have zero income in your first year of retirement and you don't do something like this and you have lots of IRA assets, you just missed an opportunity to say, take $60,000 or $100,000 roughly in income from your IRA and only pay 12%.
Right.
As soon as December 31st rolls over on that year, you've just totally missed that opportunity. And we'll talk about what you might do with that money. And I'm amazed at how many people don't think about that. I think they're so happy not to pay taxes. It's like it's a badge of honor that they end up missing that and end up paying more total tax if you look at it from a multi-year standpoint.
And sort of the same thing with taking tax-deferred contributions in the first place, whether it's traditional IRA, traditional 401k, 403b, TSP, federal plan. It feels good to save yourself some taxes in the years you're working and make those contributions, but you're not actually getting rid of the tax. You're just simply deferring it. You're kicking that tax can down the road to be dealt with and worried about some point later. Well, some point later it will inevitably show up, and who knows, maybe you're in a situation where you have a lot more income than you thought you would, so your taxes ultimately end up being higher by having deferred that income than if you would have just realized it, decades prior. So this is sort of the same thing. It feels good to lower your tax today, but you have to weigh the pros and cons of at what expense. How much more future tax am I giving myself by reducing or minimizing my taxes today?
It's never avoiding. I think that it's never avoiding tax. It's just the timing of tax.
Yes.
So let me ask you this, Andy, and if you have someone that is 3 to 5 years right before retirement, and they're relatively high income, should they continue to save in a tax-deferred way, even though the deferral period is so tight?
Yeah, this is a tough one, and I do have clients that are high income earners. They're well into the 30-something% tax bracket, and it's hard to say with confidence that you should not take the deferral, like put this into your Roth 401k instead, or put this into a regular brokerage account, as opposed to putting, $19,500 or $26,000 into your tax-deferred 401k. This is where it comes down to sort of a subjective judgment call and just trying to kind of hedge yourself a bit. And the way I like to think about it is, fast forward 20 years, the future you, I could almost guarantee, I don't want to say guarantee, but I can say with a high level of confidence, the future you will not be upset at having more Roth assets at the time. And you won't be upset that you pay taxes 20 years ago when you were in a high tax bracket while you're still working. The future you will be happy you have more Roth assets. I don't think the future you will ever say, man, I wish I had less tax-free Roth money right now. So with that in mind, even if you do maybe pay a little more taxes today than you could have or should have because you're a high-income earner and you opted to do a Roth 401k contribution, for example, instead of tax-deferred, I still don't think the future you would regret that. Now, that I can't quantify that. I can't show that in a model that's going to prove that to be right. That's just sort of this general sort of qualitative feeling that I think will hold up over time.
Yeah, this idea of your future you, I think, is important. I'm reading a Jordan Peterson book right now, and he talked about that. We think of who we are as Andy, I'm looking at him, Roger, today. In reality, even with yourself, you're thinking for a community, right? I'm thinking for Roger today. I'm thinking for Roger 1 year from now. I'm thinking for Roger 5 years from now, and so forth. So all these versions of me is the community of Roger. I have a community. And you got to take those dudes into account, or those gals into account.
Great analogy I heard. Picture a seesaw. One side is the future you, one side is the present day you. Everything you do to benefit the future you makes the present you worse off, and vice versa. Now, the goal is to try to find that balance where the present you and the future you are sort of, both equally satisfied by what you're doing. Now, again, there's no precise scientific way to do that. That's just sort of conceptually, realize you have to balance current you and future you.
That's a great analogy. I don't know who says that. So I'll tell you what I do. I'm 54. I'm in a pretty high tax bracket. I actually changed. We had a simple IRA in our company just because, a small number of employees. And I switched it to a safe harbor 401k because I had the option because I'm a business owner. You may not. Solely for the purpose of being able to contribute the max to a Roth 401k because I couldn't contribute to a normal Roth IRA. Mm-hmm. And I think one thing to consider there, whether you're contributing to a Roth 401k or even just taking the money, like you said, and putting it in after-tax accounts, is, it sort of sucks to pay the tax, but you have the money to pay the tax, and you're not going to notice the extra tax. I mean, you may notice it, but it's not going to be, life-changing. And if you're like most people, including myself, I'm probably a little bit better in this than most because I've thought about it, if you're in your late 50s, you're probably way overweighted to after-tax assets anyway. And the need to build up, whether it's Roth assets or after-tax assets, to give you some diversification tax bracket, it can be pretty substantial. I have a lot of clients they're now the future them, and they're not real happy about having so much in their deferred accounts. They have less options.
Exactly. The future you, like I said, I don't think will ever be angry at the past you for having done Roth contributions, even though it may have cost you more tax at the time. But the future you is very commonly upset at the past you for having not done more Roth type options and just pumping all your money into tax deferred stuff instead.
Yeah, our goal in this show is for you to like yourself.
All the time.
All the time.
Yeah.
Okay, so that's one, is filling up the tax bracket buckets. And I think that's a big one. I'm glad you brought that one up first because that's, I think, one of the most important. What next tool should we pull out?
This one is sort of similar in concept, is Roth Conversions. So picture the same scenario, retired at 60, wages go away, you have no other income because you have not yet started pension, Social Security, RMDs aren't put in your face yet either. still take advantage of those low tax brackets by realizing some taxable income. Now, you can do that option A, like we just discussed, by just simply taking out distributions from your IRA to cover some living expenses, or if you don't need it, just turn around and put it back into a bank account or a regular brokerage account. Or another way to help get ahead of the eventual taxes on your tax-deferred money, do some Roth conversions. Assuming it's all traditional pre-tax, there's no after-tax, every dollar you convert will be included in taxable income in those years. So you're still meeting the objective of filling up those lower tax brackets and not letting them go unused. But the difference now is, instead of taking out distributions to spend or save as cash, you are instead putting the money into a Roth account so it can still continue growing and eventually be used down the road tax-free. So that's another good time opportunity in those early years of retirement before your other sources of income start to do Roth conversions and or take distributions like we discussed before.
And with Roth conversions are interesting to me in the planning community because there's this whole wave. I think it's really just fun to talk about. And I think, and it's fun to read about. And people get really motivated about doing this. And there are some people that are very adamant about very significant Roth conversions, and you're crazy if you don't do it. And that's probably the extreme approach. And when as you were talking about that, to think about it in an organized way, right, Andy? You have to first know, one, at least a 5-year projection of what where you'll be income bracket wise. So you can understand taxes. And then 2, if you retire at age 60, go back to that example, and if you don't have any after-tax assets and you need money to live on, you may not be able to do Roth conversions because you actually need the money to live.
Right.
And so having some tax diversifications might give you options to do these Roth conversions. So you have to have those things in place in order to even think about this.
Right.
On a Roth conversion standpoint, Andy, and I know we've talked about this before, but in the context of this, how aggressive should someone be?
That's another unsolvable, that the right answer will be different for different people based on their specific financial circumstances. How big, how lurking is their future tax deferral issues? What's their own personal views and opinions and beliefs about the future of tax legislation and or the government? What's their income now? Do they have the cash to pay taxes on conversions? Are they okay with paying more tax now? Some people are just, no matter what you tell them or explain to them, are fundamentally opposed to paying more now than they absolutely have to at a minimum. So I work with people across the whole spectrum. I work with some folks that I think over-convert, but that's okay by them. They're in the 30+% tax bracket. They want to convert as much as possible simply because they're that concerned about the future of taxes and, runaway debt in this country and whatever it may be. Their concerned taxes are going to absolutely skyrocket. So their bet to themselves is, I'm betting it's better for me to pay 32% tax now on these conversions as opposed to just let the money sit there and potentially have to pay more than 30-something%. And then other people on the other end of the spectrum, they don't think future taxes will be that bad, or simply they don't care. They just want to be happy. They're like, I get what you're saying. I just want to live my life. I'm in a position where I have enough money that none of this, not to say it doesn't matter, but I'm going to be okay regardless. I don't want to have to worry about this fine tuning. Let me just do my thing and be happy. So it really all depends.
No different than my father-in-law will drive 15 miles to save 5 cents a gallon on gas.
Yeah.
I will not, right? So I like to group decisions about in retirement planning between feasibility, stability, or resilient, having a resilient plan, or optionality. And this is an optionality, optimize, right? Is to really dial in and optimize the plan. Ideally, Roth conversions being one of them. If you get it exactly, 100% wrong, it's not going to impact your actual retirement plan in any way. It's just an optimization. I should have had chocolate, I got vanilla, but hey, I'm still eating ice cream type of thing, right?
Right.
And one thing I tell clients, and I think it's a good way to think about these things, are The key is, for me, is to understand what options you have, in this case with Roth conversions, and what the potential impacts are, what the ripples are of these decisions. And my job is to help. Well, if this is what you want to do, here are the potential ripples. Here are the ones that we feel pretty good about, and here are the things that could happen, good and bad. And that will help tease out how aggressive you might want to be. What made me think, when I was thinking about Andy, and then everybody's going to make their own decision based on, their handicapping of those risks and rewards. I was thinking about when I go to Salida and I mountain bike, or when I've been to Moab, there are a lot of places on a trail when you're mountain biking, you're having a blast, where you have some choices. You have the path to the left where it's really smooth. And then you have a path in the middle where you're going to have some fun. You could fall, but you feel you have some visibility there. And then you have the path directly ahead of you where you're going to barrel down and be one of those videos where you're either going to have a blast and be awesome if you have your GoPro going, or you're going to crash and be in the hospital. And some people choose barrel down. Some people choose the bunny hill. Others choose the middle. I'm generally a middle kind of guy. Right? I like to have fun, but I like to not go to the hospital most of the time. And that's sort of the decisions.
You know what's awesome about you? Your ability to take practical life examples and other things and make analogies to retirement planning. I don't know.
That's how I make sense of the world.
Yeah, it's awesome. Keep it up. I wish I was able to come up with like real world things and translate them as elegantly as you do to this stuff.
But like your friends that are barreling down, I don't care how much tax I pay now. That's cool. They just realize that, hey, they're going to look back and say, oh man, taxes are lower. They went to a flat tax and a VAT,
right.
And with maybe some regret, but they just at least know it going in, right?
Yeah.
But Roth conversions are, I feel like they're more talked about than done.
Yeah, and that's partly the industry and the media's fault for making these such a glamorous looking and sounding and sensationalized thing. People often ask, how much money should I have in tax deferred versus Roth versus regular, brokerage assets? And that's another thing that there is no answer. My answer is a quote unquote healthy mix. And what I mean by that is ideally, if it's feasible to do to get you to this point, when you hit retirement, it'd be nice to have different buckets of taxability of money from which you can pull. Some is going to be IRAs where it's always fully taxed. Some will be Roth where it's completely tax-free, and then regular brokerage where, depending what you're selling inside the account, maybe it's taxed, maybe it's not. That's flexibility. That gives you control and optionality over how you realize your income and your taxes. That's a great spot to be in. A lot of people have 90+% of their investable assets in tax-deferred accounts. They don't have that optionality. It's simply every dollar I take is going to be taxed. So if you can get ahead of that, rejigger your accounts, the taxability of your accounts a little, great. But there is no optimal answer for how much should I have in each bucket of account types, unfortunately.
Yeah, but Roth conversions are a great tool.
They definitely are.
That we
for the right people in the right circumstances, yes. Caveat.
Well, yeah. I'm thinking of all those tools in my toolbox that I would love to use because they're so cool looking, but I never really have a need for them. So let's put our hand in. I'll do this one. What is this? Which one do we want to talk about
Oh,
next?
man, that looks like the tax loss and gains harvesting tool, actually.
Ooh, that's a cool one.
Shiny. All right, so this only applies to regular, normal taxable brokerage accounts. It does not apply to qualified accounts such as IRAs, Roth IRAs, HSAs, because anything you sell within those, there's no tax consequences at the time. You're only potentially taxed when you take money out. But with regular brokerage accounts, anything you sell is likely going to have a tax impact. If you sell something at a gain, that's a taxable income to you. If you sell something at a loss, that loss can reduce your taxes perhaps, or will to some extent. Or if you sell it, coincidentally at exactly flat from where you bought it, then it's a wash. It's a non-issue. So tax loss and gain harvesting is a way to sort of consciously and tactically sell positions at gains or losses to optimize some tax situations. So for example, maybe you have some stocks that you've owned for a while that have turned into dogs that are now at losses from where you bought them, but you don't quite feel that firmly yet about getting out of them, so you're just kind of sitting on them. You have what's called unrealized losses. You get no direct tax benefit from those until you actually sell them, if you sell them. Now let's assume you have another position that's done wildly well, beyond your expectations, and you want to cash out, take your chips off the table. So you sell that stock or whatever, mutual fund, whatever, that's at a big gain. The upside is you made money. The downside is, man, now I got to pay tax on that. Well, guess what? You have these other positions, these losers that you've been sitting on. Now's a good time to, quote unquote, harvest them. You can sell them, realize those gains, realize those losses, and those losses will offset the gain you had on your winner. So now it's just the net gain or loss that will be the taxable item for you in that year. So that's an example of tax loss harvesting.
So to put some real numbers to it, if you sell something and you had a gain of $100,000, that was the gain, the amount that you earned. Well, you're going to have to pay, well, let's keep it simple. Long-term capital gains, we'll assume 20% tax, right? So that's what, 20 grand?
20 grand.
So you're going to owe $20,000 on that $100,000 gain. But if you have this other position where you sell it and you realize, say, a $20,000 loss, you can take 20% of that, which is what?
20 times.
See, we don't do math.
We
never do math
grand.
live. You can now, rather than own $20,000 in taxes, you're only going to owe $16,000 in taxes. And this is something people don't think about that often. And so some nuances to this. What happens if, well, I still like, let's say it's a semiconductor company. And I still like semiconductor companies, but this one I own is at this huge loss. And I don't want to sell it because I still think it's a valid investment. But hey, it's a big loss, and I could use that loss. Your knee jerk might be, well, then just don't do anything. But you have options. One option would be you could still sell it, and then wait 31 days, and then buy it back. And the reason you have to wait 31 days is they have what's called a wash sale rule, where if you buy it back within 31 days. The IRS says, no, we know why you did that, and they're not going to let you have the loss. So you have that option, but then what happens if it goes up in the next 31 days, and then I missed out? You could also sell that individual stock, say, of a semiconductor company, and still maybe buy an ETF that has a basket of semiconductor companies. So you still have exposure to the industry, and that company may be part of that little ETF or index. So if it's a company-specific event that makes it go up, maybe you don't participate 100%, but you still have exposure. So you have some things that you can do. Now, what you have to watch for there is, let's say you're doing this with an ETF, and you own ETF Semiconductor Index A, and it's at a loss, and you sell that and then you buy another ETF that's semiconductor based. You're getting into a little bit of a gray zone there as to whether they are, I forget the term they use, not substantially equivalent. Is that
substantially identical? I think it is.
Identical, yeah. And you're getting to a gray area there. If ETF A and ETF B are tracking the same index, you're probably not. You're probably really in a bad area. If they're tracking different indexes, I don't know if there are really hard and fast rules on that. Are there, Andy?
No, there's not clear guidance. So for example, if you were to sell one S&P 500 index at a loss and immediately buy a different one, like you sold iShares and you bought Vanguards or whatever, fill in whatever company you want, I would not be comfortable doing that. There's not specific guidance saying you can't, but that very much flies in the face of the spirit of wash sale. Now, with a sector-specific index, like let's say you sell semiconductor sector A that has 20 companies in it at a loss, and you buy semiconductor sector fund B that has 30 companies That's not substantially identical. I'd be comfortable saying that's different enough. What's clear is if it's the same company. So you sell company ABC, you cannot buy back stock in company ABC within 30 days. Similarly, you can't buy options on it. You can't buy futures on it. You can't buy warrants on it. You can't buy convertible bonds on it. Those would all qualify as a wash sale. Now, for what it's worth, wash sales are not this like dirty, nefarious, like the IRS comes and takes you to jail thing. All that happens is that the loss that you had, you cannot deduct it in that year. That loss instead gets added to the cost or basis of that position that you subsequently rebought. So you do eventually realize it at the time when you sell it. You just can't get the benefit of the tax loss in that year.
Yeah, we're getting a little geeky on that, but it's a good tool. We're here at the beginning of the fourth quarter, and this is a project we do internally of, where are there opportunities to neutralize realized gains. And one thing a lot of people don't realize too, I think of this, we mainly use very passive things that are pretty efficient here. But if you have more active mutual funds, there are a lot of capital gains that get realized within the mutual fund, usually in November and December. And they get reinvested most of the time. And those are gains that can sort of sneak up on you. And if you realize more losses than you have gains, it's like 3,000 still. You can only write up to 3,000. But the good thing is a loss that you can't use this year, you can book for future years. It's called a tax loss carry forward. And so during periods of time, a good example of this, Andy, in March of last year, when COVID was first hitting and we had the stock market go down like 20%, and it was scary.
Yeah.
We actively did that, right? We did swaps. We sold something for a loss and bought something somewhat equivalent, or to give us exposure, just to book the loss. That was the only reason that we did it.
Mm-hmm. Yeah.
So when you have major market volatility, it's just something to think about. Do you use that at all, Andy? How do you think about this in practice?
Yeah, no, definitely. So opportunities, you always look for the silver lining. So March of last year was nothing short of real scary. Precipitous drop. There's never been a drop that big in that short a time, which was concerning. But yeah, so March 23rd last year was the bottom of the S&P, and then it's rallied hard ever since. But yeah, exactly, that's a good opportunity to reassess what you have. If you have a lot of things that were big gains you don't want anymore, that could have been your opportunity to sell it, because maybe those gains are less or even at losses. Sell it, reinvest into other things you now want to hold. So definitely good opportunities.
Or do Roth conversions.
That as well, yeah.
Yeah.
You get more bang for your Roth buck when share prices are low, because for a given dollar amount of conversion, you can convert more number of securities. So the eventual rebound and growth will all be in the Roth world, which is nice.
So we see how these tools can work together in some ways.
Right. And just one more thing, tax gain harvesting, the other side of, or I guess the complement to tax loss harvesting. A little more out there, a little more difficult to explain, but basically it's long-term capital gains. So things you sell that you held more than a year are taxed at either 0, 15, or 20% currently. In order for it to be taxed at 0, your total taxable income can be no more than like $40,000 if you're single, or $80,000, slightly more, but $80,000 if you're married. That's inclusive of the amount of your gain. So if you're in a super low income year and you have a security at a big gain, for example, you can sell off some of it, realize that gain at potentially 0% tax, or maybe 15, but harvest that gain, realize the income when it's in the low tax situation. And if you still like the position, you can simply turn around and reinvest the next day. Unlike the wash sale rule, where you have to wait 31 days to rebuy a loser, you do not have to wait to rebuy something you just sold at a gain, thankfully. That's tax gain harvesting.
So quick example, if you have 0 income in a huge concentrated position at a gain, you could sell enough to realize, say, 40,000 of the gain.
More than that, with your standard deduction,
yeah,
if you're single, it's like 55,000 roughly. Yeah, exactly.
Yeah. Yep. Yeah. Great point. Or you could, if it's not 0, you can move up before you get to 20.
Yes. Right.
Yeah, great point. Thanks for stopping me. That's a good point.
Sure.
And in this day and age, after 13 years of amazing markets, it's hard to find tax losses.
Yeah, really good problem to have. But yes, a lot of clients simply don't have losses. Everything's at a gain, which is good, I guess.
Okay, I think we have one more tool we're going to look at, and that is, let me grab it, qualified charitable donations.
Yes. So if you are, this only applies if you're 70 and a half or older, and if you have an IRA with traditional pre-tax money in it. It does not apply to 401ks or other employer plans. And if you're charitably inclined, you can make donations straight away out of your IRA to a qualified charitable organization. You do not distribute the money to yourself first. It needs to go directly from your IRA custodian to the charity. That is called a QCD, or qualified charitable distribution. The benefit is that distribution can take the place of your RMD. So if you happen to be over 72, you need RMDs. You can do QCDs in lieu of taking RMDs, so if you don't need the money. And the amount that leaves your IRA does not show up in your gross income on your tax return. It just simply effectively leaves your IRA and disappears and goes to a charity. So it can help you reduce other taxes as well, because some other taxes are keyed off of your gross income, and QCDs do not hit your gross income.
Yeah, so these are important tools. And I would be remiss in mentioning the Roth Retirement Club, which is our online community where we have active conversations on taxes, on non-financial things. We have a whole master class for you to build your retirement plan and figure out how much you can spend and whether you'll be okay. And what made me think of that is we just had a live meetup with Andy in the club where for an hour, Andy helped us. He was the interpreter, and he walked through a 1040 tax form and explained exactly how it works operationally. And that's valuable to figure out what numbers key off of what. And that's the kind of stuff we can do in the Roth Retirement Club, which you can join at rockretirementclub.com. So now next week, Andy, we have a big task. We are going to talk about, and we've hinted on this and talked around it, how do we incorporate these tools to avoid these bombs in actual retirement planning? So we're not going to have some perfect method, but I think we can talk about how you integrate all these things. Are you up for that?
I am definitely up for it. And congrats again on this being the 400th episode of the Retirement Answer Man.
Thank you, man. Thank you. Let's go set a smart sprint. And we're off to set a little baby step you can take in the next 7 days to not just rock retirement, but really rock life. So in the next 7 days, it depends on who you are. If you are retired, in the next 7 days, make a very simple spreadsheet or even a piece of paper and map out the income that you expect to receive over the next 5 years. It could be Social Security, it could be pension, it could be part-time work. Map that out and look at that total so you have an understanding of where you may fall from a tax bracket perspective. That's a good first little baby step. Now, if you're like Andy and me and you're not retired, but you're close, which Andy and I aren't, what I would suggest you do in the next 7 days is, it's a good time to do it anyway because we just finished the end of the third quarter, is to build your net worth statement and categorize your assets, your money, between after-tax assets, tax-deferred assets, 401ks, IRAs, etc., and tax-free assets, Roths, health savings accounts, etc., and total each one up so you have an understanding of where your tax diversification. That's going to start to give you some insight into what you might be able to do next. All right, everybody. We will talk to you next week. Andy, thanks for hanging out with us and for the celebrations and kind words.
Thanks for having me. I'm honored to be part of this. Thank you.